Welcome back to this special conversation. Market editor and our guest editor for the day, as you can see, is Ridham Desai. We've been discussing some of the themes that Ridham is quite optimistic on from the medium to long term. One of them is industrials. We had a conversation with Mr. Bangur just a while back. The other big theme that he likes is financials. And you can see Mr. Selvan is with us. And Ridham will have some questions to Mr. Selvan in just a second. Before we get to that, Ridham, just very quickly, 30 seconds for context, expand on that point. And you mentioned it earlier. The RBI is pivoting, they're boosting liquidity, they're cutting rates. The regulatory, maybe quote-unquote, overreach is reducing to an extent. And I think you also made a point on private capex, which you say is going to increase. Again, contrary to some other opinions in the market, which everybody's crying about private capex slipping, to levels below 11% of GDP in FY25. So what makes you optimistic on financials, and within that, how important will the private capex recovery be?
So if you take it from a long-term perspective, credit to GDP in the private sector is in the mid-70s, and India's per capita income is rising. And when that happens, people spend their future. That's what debt is. You're spending your future. It ends very badly, but that's beyond our lifetimes. In the meanwhile, people will spend their future.
2008 was within our lifetimes. Even I was covering the market back then.
We were only at 50% credit to GDP, and our banking sector did not have a problem. We faced a problem in 2008 because of oil prices, not because of a banking sector issue. We had a banking sector issue in the middle of the last decade because of NPLs. But even then, credit to GDP still remains low, adjusted for our per capita income, and there is no reason to believe why this will not go into 3 digits in the next 10 years. And you can do the math. If 75 goes to 100, nominal GDP growth is 10-11%, you get credit growth at around 15-17%. Good companies like Chola can do better. And, more or less margins are stable. Even if they're slightly down, if you can manage your credit costs, you're delivering 15-17% earning growth. Anybody at these multiples, there's a lot of money to be made in this.
Okay, fire away. We've got Mr. Selvan waiting for your questions.
Yeah, hello, sir. Thank you for joining this. I'll actually kick off. I'll kick off with this question on how are you seeing the trends out there? What's happening to growth? What's happening to your to the margins? I think if you can answer those two questions, then we can take it from there.
In Chola, as you know, we are having multiple products. Though our concentration is on vehicle finance, we have also, over the period grown other products like loan against property, home loans, and now we are also into a bit on the unsecured and SME funding. So we have multiple levers to push when that is growth, slow down in one sector versus the other. So we have been doing this, and we are confident of delivering anywhere between the 20 to 25% growth on the AUM over the next 2 to 3 years. So that is on the growth side. On the yield, on the profitability, yes, here again we see that we will be able to deliver a 20 to 25% growth on our profitability, derived from yield improvement, cost of funds reduction, as well as productivity improvement, which will result in OPEX reduction.
Sir, has the correction in the stock market played any role in your credit cost? Are you seeing any slippages? Is the mood out there changing, or it's actually it's okay?
Many of our borrowers, or most of our borrowers, are not those who play in the stock market. They are transport operators. They are businessmen who are into small and medium industries, which is primarily on the lab side, and the self-employed non-professional. So we don't see too much of stress coming on, because they lost the money in the stock market because of the corrections in the market. We have a very, very small loan against share property, and even there we have not seen any stress building up.
I want to go into a couple of long-term issues. One is on AI and ML, and the other is on India Stack. So let me start with India Stack. So how is India Stack dovetailing into your business, and how do you think that's going to affect the way you do business in the next, say, 3 to 5 years?
India is a growing country with a lot of credit appetite. Still India's large amount of credit supplied through the unorganized segment, which is where we come in. We do the last mile delivery. We do the financial inclusion. Most of our assets are priority sector assets, which on the other side helps me get the liability, delivered from the banks, because we give them the priority sector and we get finer rates. This helps us. The ability to assess credit of these self-employed non-professionals and the ability to collect from them, though the underwriting or the credit assessment parameters are a little bit opaque for them, and they don't really pay on an exact delivery rate like a salaried employee. But we have mastered that part of collecting from them, was also assessing them and delivering credit to them. This is actually a good entry barrier, and so it helps us to scale up in these segments. And because India has got a lot of appetite in this segment, I think there is a good growth opportunity for us.
And on AI, how is that affecting your business? And are you seeing use cases of AI, or is it still too early for us to use AI in India?
No, AI we can use. See, AI cannot replace the entire process. AI, it can assist us in credit evaluation, in collection evaluation, in understanding the behavior of the customer when we see the response, when we call them on and then assess the promise to pay commitments. Then it helps us to draw patterns to understand whether this guy will pay on the date or not pay on the date, and will he need further time. So it's a sort of an assisted journey between the feet on street and leveraging AI. It cannot completely replace the feet on street, at least for the time being, or I would say next few years. So we need the feet on street to make sure that we do the assessment, we visit the customer, we see the property, we visit the showroom or the shops of the customers, and then we see the vehicle conditions. These things cannot be, in my opinion, replaced by AI, because still we are a little far away from building these capabilities on this count. But it helps us to assess what is their past performance, how many vehicles they ran, what sectors they ran, what is the businesses they are involved in case of LAP and HL. This helps us to assess them and make it. So it helps us to better assess and give an assisted journey to the whole process.
Sir, I have two more questions. One is on system credit growth. So system credit growth, as we know, has slowed from 16 to 11. What are you assuming system credit growth for the next fiscal in your budgeting?
See, if you look at it in vehicle finance, the sectors we operate in, the lights and mini lights, we expect it to grow by around 7 to 8% because rural is picking up. Rural has got a good crop in the Kharif, and Rabi is also expected to be good. And at least the initial estimates for even next year's monsoon is fairly, reasonably good. Considering this, and now that the elections of most of the states are over, and then the governments have come into play, now they will also start spending on the rural, which will help consumption in the rural, and thereby help transportation to those parts, which is primarily driven by the lights and mini lights, which is where our strength lies. So we see that 6 to 7% vehicular growth in volume terms, added with the inflation or the price increase, and also the shift in the preference of customers from buying smaller tonnage to a slightly larger tonnage, progressively moving up the tonnage, later. This helps us to assume easily a growth of around 18 to 20% on the vehicle finance. The loan against property and the HL part, we are doing still a lot more geographical expansion is possible. We are not fully covered the entire length and breadth of this country. So we will be growing more from the geographical expansion, and that would give us the growth. So these are the three large parts of the business which would ensure that the company grows by at least 20% in the coming year.
Wonderful. So last question. This is the perennial debate between NBFCs and banks. At what size does liability constraints start emerging, where you have to think about thinking your business? Is there a size, or you think that's not a constraint actually?
Actually, I don't think that's a constraint. Thankfully, I have two elder brothers, Sriram and Bajaj, who are much larger than us, and they are comfortably doing. Yes, I need to look at growing or reaching out to the international market, international bonds. There could be some price sacrifice we may have to give initially, at least when we enter these markets. But I think we have the reputation, the group has the reputation, and Chola has got the reputation. And the equity markets where we have participated in these overseas countries, we have got very good, credibility. So I think that should brush off on our debt side also, and we should easily be able to get money from overseas investors also on the debt side. And I think that should not have put any liability side pressures on us.
Thank you so much, sir. This is really useful in understanding what's happening here.